Bismillahirrahmanirrahim. In part 1 of different accounting principles, I have discussed about some of the principles, the generally accepted accounting principles. This is the part 2 of the previous lecture. In this session, I will discuss the further different approaches of accounting and different accounting conventions and principles. Taking start from the previous last slide, materiality convention. A financial statement item is material if its omission or misstatement would tend to mislead the reader of the financial statement under consideration. This statement simply means that if you miss such a statement, or if you miss such a figure, or if you omit, if you omit such a statement, that would definitely be having a very huge impact on your financial statement, could be material. Right? Materiality often depends on the size of the organization. Right? What is material to one company might not be material to another company. It depends upon the nature and size and the different aspects of your materiality. Something, if it is material for an organization, or something if it is not material for an organization, is really a matter of different aspects. There are different items, there are different elements which, according to the nature and size of that company, matters a lot. If you omit something, or if you present something very inappropriately, or if you present a misstatement, this would definitely be having a very huge impact on your financial statements. And financial statements later on, they are for the use of the users of accounting. If the users of accounting, they are being misled, then the investment capacity will be reduced. No more investors will come to your company. No other creditors will give you loans, and above all, the auditors will very negatively represent your financial statements. AAA defines, American Association of Accounting, an item should be regarded as material if there is reason to believe that knowledge of it would influence the decision of informed investors. Your investors are your big participants for the expansion of your company. If your investors are being misled, if they are provided with false statements, or if they are provided with something with omitted figures, would really having a very bad impression on your company financial position. So therefore, disclose all the material information. No overburdening with minute details. Material information differs organization to organization, from year to year. The methodology of depreciation, materiality may depend upon amount or may not be. Different aspects, as I told you, there might be different aspects. So these different aspects covers different elements of the financial statements. Convention of conservatism. Conservatism is related with anticipation. Anticipate no profit, but you must definitely provide for all the possible losses. It means that you must create a preservance aspect for your losses, but you cannot anticipate your profit. This is the basic theme behind the conservatism convention, or the conservatism principle. Policy of caution and playing safe. You must be cautious about the financial position or the financial status, and you must playing safe. It means that whatever decisions you are taking, or whatever steps or whatever practices of accounting you are carrying out, you must play safe. You must be safe at every aspect. You must keep your business at a very high priority to make it safe with regard to losses. And you must be also very cautious for taking any decision. Policy of safeguarding against the possible losses in world of uncertainty is called as the convention of conservatism. Kobler defines conservatism as a guideline which chooses between acceptable accounting alternatives, means different choices. You must choose different choices for recording events or transactions, right? Events are the economic events, and the transactions are the financial transactions, right? That we have gone through in the previous lectures in detail. So conservatism is a guideline which chooses between different acceptable accounting alternatives for making a very good record of different economic events and transactions, so that at least favorable immediate effect on assets, income and owner's equity is reported. For example, making the provision for doubtful debts and discounts on debtors in anticipation of actual bad debts and discount. Provision for doubtful debts. For example, you have extended certain loans and you think that these loans are not recoverable, that will become doubtful debts. So you should provide for discounts on debtors in anticipation of the actual bad debts and discount. Right? If your doubtful debts are increasing day by day, right, you should increase the discounts, and you should also anticipate for the actual bad debts. Cost benefit criterion. Cost benefit, again, the basic theme behind accounting, that your benefits must always be greater than your costs, right? Cost is the actual amount spent on producing a product, right? And the benefit is the actual profit on that already spent out cost. Cost is the value sacrificed for securing a benefit, right? Cost is basically the value sacrificed for securing a benefit. A system should be changed when the expected additional benefits of the change exceed its expected additional cost. The benefits of information should exceed the cost of providing that information. Exactly. If your cost is going high, your business will go into losses. If your benefit is less than the cost, your business is not in fruition. You will go into losses. The stable monetary unit concept. This concept is also very important in accounting because the purchasing power from time to time with different market dynamism and different market changes and prevailing equilibrium status in the market affect the monetary unit. For accounting, your monetary unit must be stable, right? Which is also called the stable dollar assumption, right? If your monetary unit from time to time it changes, your balance sheet will badly be impacted, because according to the cost principle, you must record your assets and other elements according to the cost principle at its original price, right? If this monetary unit is not stable, it will having a very bad impact on your balance sheet, and this will violate the other principle, which is called the historical principle or the cost principle. So the purchasing power must be stable. For it, The purchasing power must be stable. The monetary unit is the principal means for measuring assets and equities. Assets are the probable economic resources of the business, and equities are the claims. It is the common denominator for quantifying the effect of transactions. A stable monetary unit is one that is not expected to significantly change in value over time. It means it must remain static. It means it must remain static in the sense that it must not be changed from time to time with different inflationary and interest pressures. It must remain constant. The cost principle is, with this stable dollar assumption, I recently explained a little bit about the cost principle. Assets and services acquired should be recorded at their actual cost, right? If you bought a building for 20 lakh, right, in 2020, you cannot change the price in 2021. Though the market value of that building must be definitely high in comparison to the previous year, in comparison to the previous cost of 20 lakh or 2 million. But according to rules, according to the cost principle, whatever you record on the balance sheet must be at its original price, and for a number of years till the life of the business, this price must be 2 million for that building that you purchased initially. What are the crux of this principle? There are certain points of this principle according to which you must regard your elements in balance sheet. Record all the assets at price paid to acquire and take it as base for subsequent years. Means that in subsequent years these assets will also be recorded as it was recorded in the previous year. Makes financial statements more objective. Yes, your financial statements will become more objective if you present the actual prices. But there are certain limitations as well. What are the limitations of this principle? Number one, financial statements become irrelevant in case of inflation. Exactly. Look at this point. This point elaborates that your financial statements will become irrelevant in case of inflation. What does it mean? In inflationary pressures, the prices are going up, but you cannot change the prices. Your asset prices will remain static, unchanged. Remove cost of fixed assets by writing off their cost while asset may be in good condition, right? Sometimes the asset might be in good condition, but due to these inflationary pressures, we have to write off the cost. We cut off the cost. Don't show as asset for which no payment has been made, for e.g. knowledge, skill of human resources. These assets are not recorded because though they are the assets for the business, but as there is no payment made for it, therefore we cannot show them as assets in the balance sheet. There are different aspects, there are different other approaches. There are different approaches to accounting: cash basis of accounting and accrual basis of accounting. The cash basis of accounting will record only the cash transactions, and accrual basis of accounting will record only not only the cash transactions as well as the credit transactions. According to these two methods, which is normally used in accounting software, in Peachtree accounting software there is an option, a clear option, whether you are following the cash basis of accounting or the accrual basis of accounting. Cash basis of accounting will record the revenues reported when cash is received, expenses reported when cash is paid, does not properly match revenues and expenses, right? Because only the cash aspect is recorded, only cash transactions are recorded. Therefore, the circle of activities will be reduced. Therefore, the circle of transactions reduces because only cash transactions are to be recorded and to be focused on. In comparison to the cash basis of accounting, the comprehensive accrual basis of accounting is another system, is another approach which is used in accounting, right? In accounting information system. The following are the certain characteristics: revenues reported when earned, expenses reported when incurred, properly matches revenues and expenses, determining net income, requires adjusting entries at the end of the period. Adjust sounds mean, it really is not. Accrual basis is the comprehensive system, and the accurate system and the circle of business activities, the circle of transactions will be greater than the cash basis of accounting. Another comparison: accrual accounting and cash accounting. Accrual accounting focuses on the economic impact of transactions. Cash basis of accounting focuses on when cash is received and paid out. Firm maximizes in the accrual accounting, firm maximizes assets, while in the cash accounting, firm maximizes only cash. Full disclosure principle. This is another principle, the full disclosure. According to this principle, the full disclosure, you have to state each and everything on the balance sheet. Circumstances and events that make a difference to financial statement, user should be disclosed. User must be informed. Your financial statements are the income statement, the balance sheet, the retained earnings statements, the cash flow statement, the statements of owner's equity. So full disclosure means you must have to present all your assets, all your contingencies, all your controversial issues in the notes to the financial statement, and all the relevant and accurate issues on the balance sheet. According to full disclosure, nothing must be kept secret. Each and everything must very clearly be explained and very clearly be presented to the general public, to the investors, to the users of accounting. Revenue principle. According to this principle, it is quite necessary, like when is revenues be recognized, when revenues are deemed to be considered as earned. Recognition of revenues and cash receipts don't necessarily occur at the same time, right? For example, services are performed for someone and receiving the payment of these services at some future later date. It means that your revenues are to be received in future, which will be converted to receivables, and cash receipts are something else, because cash receipts from other activities would be treated different from revenues. Revenue principle. The revenue principle governs two things: when to record revenue and the amount of revenue to record. When to record revenue simply means that if the services are performed, you must record the revenue. In the accounting records, revenues must be recorded. The amount of revenue to record, the amount of revenues will then be adjusted through the adjusting entries in the books of accounts when it is actually received. Revenue principle. Look at this example about the revenue principle. I plan to have you make my travel arrangements. A&C Travel and Corporation, March 12 is the date and the name of the business. Situation 1. No transaction has occurred. Don't record revenue. But in comparison, look at the situation 2. The client has taken a trip arranged by A&C Travel. Here, you are bound to record revenues. Recognition of revenues. At this stage, a test to determine whether revenues should be recorded in the financial statements for a given period. To be properly recognized, all the revenues must be earned. Means that goods are actually delivered or a service is actually performed. Realized means that cash or claim to cash or credit is received in exchange for those goods and services. The matching principle. The matching principle is another important principle for income statement when your revenues and your expenses are matched and a favorable difference is determined. That favorable difference is called as the profitability of the business. What are the major characteristics of this principle? Number 1. What is the matching principle? It is the basis for recording expenses. Expenses are the cost of assets and the increase in liabilities incurred in the earning of revenues. Expenses are recognized when the benefit from the expenses is received. All expenses in businesses are incurred to secure benefits. All costs are expenses. For a normal business, all the routine activities of the business, all the routine financial activities of the business are recorded, but with the incurrence of these activities, with the incurrence of these financial transactions, there might be some expenses, and without those expenses we cannot incur those activities. So expenses are incurred to properly generate more revenues and to beneficially incur the activities of the business. Look at this matching principle. It is the basis for recording expenses and includes 2 steps. Identify all the expenses incurred during the accounting period and measure the expenses and match expenses against revenues earned. The basic theme is the comparison between the two, revenues and expenses, and the favorable difference determination. If your revenues are greater and your expenses are less than, simply revenues minus expenses is equal to net income or net profit. But here the situation is opposite. If your revenues are less than and your expenses are greater than, then the business will definitely go into losses. So revenues minus expenses equal to net loss. Example, the matching expenses with revenues. For example, a business earns total revenues 15,000 and the cost of goods sold 8,000. The net income is very simple, 7,000. Accounting period concept. This is another important concept. Accounting period concept. Managers adopt an artificial period of time to evaluate performance. This period normally consists of 12 months. Normally, financial statements are prepared at the end of the accounting period. An accounting period consists of 12 months, but sometimes for accurate decision making, monthly statements are prepared, quarterly statements are prepared after 3 months, semi-annually or interim financial statements after 6 months are prepared, third quarterly financial statements after 9 months are prepared, and at the end, annual financial statements which are prepared after 12 months period, and also the end of the accounting period. According to this pre-period concept, the statements are presented to the general public after auditing. It requires that accounting information be reported at regular intervals. Interacts with the revenue principle and the matching principle. Requires that income be measured accurately each period. Businesses need regular progress reports, so accountants prepare financial statements for specific periods and at regular intervals. As I recently discussed at the start of this principle, that monthly reports are prepared, quarterly reports are prepared, third quarterly reports are prepared, and after 12 months, annual reports. Dual concept. The dual concept is the basis of accounting transaction, financial transaction. Accounting information is based on the double entry system. Under this system, the two-sided effects of a transaction is recorded in the appropriate accounts. The double impact or the dual impact of financial transaction is the perfect approach. Like every transaction must have a certain aspect of exchange. The recording is done by means of a debit credit convention, set of rules applying to all accounts. In accounting equation, you are not connected with the debits and the credits, but the next chapter, which is the capturing economic event, a dual aspect concept is required. The dual aspect concept, the giving aspect and the receiving aspect, and in technical terms we call it debit or credit convention. Look at how these rules will be applied. The accounting equation, assets or the economic resources of a business that are expected to produce a benefit in future, while liabilities were the outsider claims or the economic obligations payable to outsiders. And in simple terms, owner's equity represented the insider claims of the business. Reliability concept. The data which is presented to the general public or to the users of accounting must be reliable. The quality of information that assures decision makers must be purposeful, right? It must be reliable. Reliable data are supported by convincing evidence that can be verified by independent parties. An independent party, which is called the auditor, the external party, they are invited to the business for examining the financial status of the business according to the generally accepted accounting principles, and whatever report they have prepared, that report is reliable for the users of accounting. The impact of the events should be measured in a systematic, reliable manner. What is the reliability objectivity principle or concept? Information must be reasonably accurate and information must be free from biases, from inclinations, right? Information must be free from every kind of bias. Information must report what actually happened, and individuals would arrive at similar conclusions using the same data. The double entry system in detail. What is the double entry system and why the single entry system is being replaced by the double entry system. Before going into the details of the double entry system, the single entry system was the initial system where only one aspect was used to be recorded in the business, the giving aspect or the receiving aspect. But the single entry system produced very inappropriate records, very inappropriate final accounts. That's why the system was replaced by a very sophisticated system which is called as the double entry system. Now the double entry system of accounting is based on a simple concept: each party in the business transaction will receive something and give something in return. The giving aspect and the receiving aspects are fully utilized here in double entry system. The giving aspect and the receiving aspect technically in accounting be presented by debits and credits through the golden rules of debit and credit. In bookkeeping terms, what do we mean by bookkeeping? Bookkeeping is the recording phase of accounting transactions. In bookkeeping terms, what is received is a debit and what is given is a credit. The T account is represented. The T account representation of a scale or balance can be seen in the slides. The scale of balance: receive debit and give credit. Left side receive debit, right side give credit. Luca Pacioli, who is considered as the founder, or considered as the father of accounting, and also the developers of the double entry accounting, he worked a lot for accounting systems. He wrote different formulas, he wrote different theories for accounting, and he developed this system which is called as the double entry system in 1400th century, roundabout approximately. The double entry system, each transaction is recorded with at least one debit, one credit. But if there is more debits and there are more credits, the transaction is said to be a compound transaction. Total debits must equal total credit. The debit side and the credit side, they both must be in equality. Each transaction must still be analyzed to determine which accounts are involved, whether the accounts increases or decreases, and how much the balance will change, which account is related to which of the building blocks of accounting, which account will be debited, which account will be credited. Right? These are certain questions that must be asked from your own self at the time of recording the transaction according to the double entry system. Some businesses enter into thousands of transactions daily or even hourly. Accountants must carefully keep track of and record these transactions in a systematic manner called the daybook or the journal. Accountants use a double entry accounting system in which at least two accounts are always affected by each transaction. But this is not necessary that there must be only two accounts. Accounts can be 3, accounts can be 4, account can be 5. If there are only two accounts involved in a single transaction, according to the double entry system approach of accounting, the transaction is said to be a simple single transaction. But if there are more than 2, more than 3 accounts are involved, the transaction is said to be a compound transaction. Classification of accounts. There are some asset accounts, cash, notes receivable, accounts receivable, prepaid expenses, land, building, and equipments. Cash, which is the backbone of every business. Without cash, no business can be run well. Cash is necessary for every business activity. Notes receivable. Notes receivable or account receivables are the amounts receivable in some future dates. Notes receivable and account receivable are the current assets. Cash also the current asset. Prepaid expenses all the advance payments. If you have made certain advance payments, they can be termed as prepaid expenses, right? Advance payments, for example, rent paid in advance for 12 years, rent paid in advance for 1 year, right? This advance payment will be considered as current asset. Land, building and equipment, they are to be considered as fixed assets. Classification of accounts, there are some liability accounts as well. Notes payable, accounts payable are the current liabilities which are payable in near future. Accrued liabilities for expenses incurred but not paid, accrued salaries, accrued liabilities, accrued rent, right? Outstanding liabilities are also the current liabilities. The long term liabilities are the bonds, right? Are the bank loans which requires more than one accounting period to be paid to the concerned parties. Honor equity accounts are the insider claims, the capital or the honor interest in the business, withdrawals, revenues and expenses relevant to the capital accounts are the elements of the balance sheet. Further classification, according to the British approach, there are three classified names of different accounts: real account, personal account and nominal account. For real account, debit what comes in and credit what goes out. For the personal account, debit the receiver and credit the giver. For the nominal account, debit expenses and losses and credit incomes and gains. This is very comprehensive rule, very easy rule for dealing with financial transactions and for dealing with business accounts. Real accounts are normally the accounts of all the assets, right, and liabilities. The personal accounts or the accounts of the owners, while the nominal accounts are the accounts are relevant to expenses and incomes only. The double entry system, look at this comparison. The system records the two-sided effect of transaction. Bought furniture for cash and took a loan in cash. What is the two-sided effect? Decrease in one asset, increase in another asset. Increase in an asset, increase in a liability, right? Note that the accounting equality is maintained after recording each transaction. Each transaction is balanced according to the double entry approach. A sole proprietor on November 1st, 2002, A started a sole proprietorship called XYZ Limited. The following double entry transactions show how amounts received: debits always equal amounts given, credits. Amit deposited 35,000 rupees in a bank account for XYZ Limited. Receive debit and give credit. Look at the journal format. This is the journal format: 1, 2, 3, 4, and here the optional column is also developed for recording the ledger page number. How we will be recording this transaction in journal, which is called, as per the definition you were told about, the journal is a chronological record of all financial transactions, right? The two accounts involved, one is cash, the second is capital, right? Here cash will be debited. You will record this from the extreme margin of the description column, and this is the personal account. right? This is the real account, this is the personal account. One is debited, the second one is credited. According to the rules of debit and credit, increase in asset will be debited, increase in liability will be debited, right? Look at the next transaction. XYZ buys land for 20,000, land debit, cash credit. Very simple. What goes out of the business and what comes in? What comes in is your land, what goes out is your cash, right? So in this transaction you will debit land and you will credit the cash. XYZ Limited buys supplies for 1350 rupees, agreeing to pay in the near future. This is credit transaction. How? Purchases are made for 1350, receive the debit and give the credit. Why? Because your liability is created. Accounts payable is the payment of 1350 rupees will be made at some later future date. XYZ Limited earns fees of rupees 7,500 receiving the cash. Simply cash will be debited and revenues earned or fees earned will be credited, right, according to rules. XYZ Limited paid wages rupees 2,125, rent rupees 800, commissions 450 and miscellaneous expenses 275. For all these expenses will be debited, all these expenses will be debited and cash will be credited for a total sum, for a total amount. Then XYZ Limited pays rupees 950 to creditors on account. Accounts payable will here be debited because at the time of payment all the liabilities will be reduced, and cash gave credit to what goes out will be credited. Amit withdraws rupees 2,000 in cash. Amit drawings be debited, cash be credited because Amit cash is going out and Amit receives drawings. Look at these transactions very carefully. According to the double entry system, according to the double entry approach, these transactions are recorded in journal. After equation, your next step is journal, and this journal will be discussed in detail with different other rules in the forthcoming lecture. For now, these transactions were just analyzed, these business transactions were just analyzed according to the increase or decrease impact, according to the debit and credit impact, and were properly recorded in journal.